The Canadian economy, already contending with inflation, tariffs, and a cost of living crisis, is also watching a steady and ongoing slump in the housing market.
They told you the housing crash was here. They showed you the headlines about prices dropping, and they made you believe affordability was finally back. It's the biggest lie in modern Canadian history. Because the Canadian housing market hasn't crashed, it's just become sicker and far uglier than anyone is admitting.
Thousands of condos are left unsold. The Canadian Mortgage and Housing Corporation says about 2,500 new condos are sitting empty in Metro Vancouver. That's double what it was last year.
Even former Bank of Canada Governor, the immensely powerful Mark Carney, is reportedly trembling behind closed doors as prices collapse, buyers flee, and homeowners watch their hard-earned equity evaporate overnight. The story we've all been told about the crash is the distraction. The truth is a slow-motion disaster with deep, long-term consequences that will destroy the Canadian dream for millions of families across the country. We're not talking about a quick, sharp drop, we're talking about a structural, agonizing bleed where the market is stuck in paralysis, and the most vulnerable are being punished. This isn't just about real estate, it's about the very future of wealth in this nation. You need to know the hidden figures, the brutal math, and the policy failures that are keeping you locked out, even while the headlines celebrate. This video will expose the 5 most damning truths the government and the major banks absolutely do not want you to hear. Get ready, because the truth is far more brutal than you can imagine. If you want the raw, unfiltered truth behind the biggest economic lies in Canada, hit that subscribe button right now. We are pulling back the curtain on the institutions that are failing the average family, and you don't want to miss the next chapter of this crisis. The media machine is working overtime, touting an average national price drop of around $147,000, the kind of huge number on paper that leads people to think, finally, affordability is back. But this figure is not just misleading, it is a cruel, calculated joke played on the average Canadian family. This number is a mirage designed to soothe the nerves of a panicking public while the underlying economic reality remains catastrophic. To truly understand the collapse, you have to look at the numbers adjusted for the raging inflation that has eaten into your paycheck over the last 3 years. When you account for the true erosion of value, the price drop in Hamilton, for example, is closer to a stunning 40% from the peak, and the Greater Toronto Area, GTA, sits around 34%. These are massive corrections, but here is the essential, brutal paradox. Even with these dramatic paper losses, affordability is still a major problem. Why? Because your income hasn't kept pace. The benchmark used by banks is the gross debt service, GDS, ratio. The rule is simple and protective: no more than 40% of your pre-tax income should go toward housing costs, e-mortgage, property taxes, heat. Yet, in Toronto and Vancouver, an average household still has to commit an absurd, impossible to meet 85% to 100% of their median income just to afford a typical home. That means, unless you're an ultra-high earner or have received a massive, tax-free gift from mom and dad, the dream is just as dead as it was at the peak. The rate cuts, the 8 cuts the Bank of Canada has implemented, haven't magically made homes affordable. They've barely moved the needle for most people. The math doesn't lie. This isn't a market correction, it's a structural crisis where the foundational pillars of the housing system have cracked, leaving the majority of Canadians priced out of their own country. The reality is that the only people benefiting from the slight dip are the cash-flush investors and the already wealthy who can absorb these prices with ease, leaving the rest of us watching from the sidelines. The worst part? This sickness isn't leading to a quick recovery. Forget the idea of a classic, rapid housing crash. That's too clean. What Canada is enduring is far more insidious, a slow-motion crisis where the market is not collapsing, but is instead stuck in economic limbo. Sales data confirms how profoundly soft things really are. Despite 8 supposed rate cuts over the past year and a half, the response from buyers has been terrifyingly flat. At the same time, new listings keep piling up, which should theoretically create a balanced, rational market. But rational is the last word you'd use here. Sellers are in deep denial. They are digging their heels in, flatly refusing to budge on price, clinging to the phantom value of the 2021 to 2022 boom. Meanwhile, buyers are paralyzed by the cost and the uncertainty, choosing to wait it out. This clash of wills has created a paralyzing stalemate. The most damning evidence comes from Toronto, where the market is on track to record the lowest number of home sales in over 30 years. Let that sink in, 3 decades. That's not a soft dip, it's a historic low that signals a profound structural failure. The gap between what's listed and what actually sells, what we call the sales to new listings ratio, has only widened. Buyers are hesitant. Sellers are in denial. The entire mechanism that should allow the market to adjust is jammed. This paralyzing environment is not a sign of recovery, it's a sign of a deep sickness. It means inventory keeps growing, supply is technically high, but transactions are stagnant. The market is refusing to correct quickly, it's choosing to bleed out slowly instead. This slow bleed crushes consumer confidence and locks up the financial lives of millions who can't move, can't upgrade, and can't get on with their lives. But this lack of movement is having an effect far beyond real estate itself, dragging down the entire Canadian dream. There is a fundamental sickness at the heart of the Canadian economy, and it is our unhealthy, crippling obsession with real estate. We are not just building homes, we are building our entire national wealth on a single, shaky foundation. The evidence is absolutely damning. Canada invests a colossal, economy-distorting 8% of its GDP into residential real estate. Compare that to our neighbors in the US, where that figure sits at a much healthier 4%. This difference is not trivial, it is a national vulnerability and a financial time bomb. It means an obscene, unhealthy amount of the nation's capital, money that should be flowing into innovation, manufacturing, technology, and small businesses, is instead tied up, frozen, or leveraged against housing. Every single dollar Canadian spends servicing this massive, all-consuming housing debt is a dollar not spent on businesses, services, or consumer goods. When the housing market slows down, or gets stuck in a stalemate as it is now, the entire Canadian economy feels it double, compared to other industrialized nations. It's a systemic drag, a heavy chain that keeps households and the entire nation financially constrained. This obsession is why the so-called housing crisis is actually a full-scale economic strain. We've allowed real estate to become the singular driver of wealth, making the whole country's fortune dependent on constantly rising home values. For millions of Canadians, this over-reliance on housing is both a fragile dream and a dangerous trap. It dictates who can build wealth and who must remain financially constrained. When prices go sideways, or dip even slightly, the ripple effect on consumer confidence, debt repayment, and spending is instantly felt, ensuring that the economy remains in a state of perpetually slow growth. But while the banks reassure the public, a hidden danger is lurking just below the surface that could force prices lower. The banks and the government are working hard to reassure the public by pointing to the headline delinquency rates. Currently, about 0.21% of mortgages are delinquent, a laughably low number compared to the 4% seen in 2008. The messaging is clear, everything is fine, we avoided a crisis. But this messaging is a deliberate distraction from the real, immediate danger that is quietly eating away at the market, the private and fringe lenders. These lenders are not your big, federally regulated institutions like RBC or TD. They are the high-risk players financing smaller developers, speculative investors, and buyers who were already financially strained. And these players have zero interest in market stability. Their only concern is one thing: getting their cash back. When a loan goes bad, they quietly exercise their right to a power of sale. When a lender forces a power of sale, they don't care about the last comparable sale price or the neighborhood's delicate pricing structure. They will sell the property for whatever price gets them their money back the fastest. This creates a slow, devastating trickle-down effect, dragging down prices across entire neighborhoods one distressed property at a time. It's a destabilizing force that the major banks, who are still flush with government support and reserves, won't admit to because it threatens their confidence narrative. Thousands of condos are already sitting empty, and the supply of empty product is double what it was last year in places like Metro Vancouver. The developers behind these unsold, empty units are often the ones financed by these private lenders. As the construction loans come due, the private lenders are forcing properties onto the market to be sold at a deep discount. This is the unseen downward spiral, a silent, property-by-property war that is quietly setting new, lower price floors across the most critical Canadian markets. And the ultimate victims of this mess are the first-time buyers who are seeing their lifeline vanishing before their eyes. While everyone is focused on today's pricing, the Canadian housing system is setting the stage for a massive, guaranteed supply shock in the near future. The lifeline for first-time buyers was supposed to be the entry-level condo market, but condo construction in the GTA and Hamilton has slowed to a terrifying crawl. The homes that actually let ordinary people get their foot in the door are vanishing faster than you can say a GTA real estate. This problem isn't 2 years away. The full force of the shock is predicted for 5 to 7 years from now, a result of policy failure today. The pre-construction pipeline is drying up. Why? Because governments are actively killing off new supply. Development charges, the fees levied on builders for new units, have skyrocketed, jumping a mind-boggling 40% in Toronto alone in just a couple of years. That insane, anti-supply cost is passed directly onto the buyers, making a newly built entry-level unit unaffordable before the first brick is even laid. This is a policy mess that guarantees a future shortage. But the betrayal goes deeper. The market is shifting in subtle, yet profound ways. Rental buildings, often backed by huge institutional insurance companies and real estate investment trusts, REITs, are replacing what used to be available as ownership units. Small-time investors, mom-and-pop landlords, and families who once built generational wealth through owning a single condo or townhouse are being systematically edged out. They are being replaced by institutional landlords geared toward long-term, high-rent returns. The dream of individual home ownership is slowly being extinguished, morphing into a system where you will own nothing, and they will be happy. The structural shortage of freehold homes, townhouses, and semi-detached houses is becoming critical. This guarantees that younger generations will be locked out of ownership entirely, trapped in a rental-only system in their own major cities, a devastating indictment of government policy. The headline recovery is nothing more than a dangerous, government-sanctioned illusion. This market is not bouncing back, it is paused, fragile, and intensely volatile. Price drops aren't translating into true affordability. 8 rate cuts aren't driving sales. A massive, policy-induced supply shortage is looming. The numbers confirm this isn't a simple, healthy correction, it's the beginning of a slow-burn crisis with lasting, destructive consequences for millions of Canadians. The affordability myth, combined with the sticky, stubborn prices, flat sales, and profound policy failures, is creating a perfect storm. Buyers are sitting on the sidelines, waiting for a real dip. Sellers are holding firm, unwilling to accept reality. And the quiet, private lenders are slowly, brutally influencing the market's descent through forced sales. This is a slow, agonizing economic bleed, but one with devastatingly real consequences. For younger generations dreaming of their first home, the promise of the Canadian dream is being systematically withdrawn. The window of opportunity isn't just closing, for many, it's already slammed shut, leaving them to pay the price for a generation of financial obsession and policy failure. The next leg down is not just likely, it's inevitable.